What's up, guys? Frugal BC got a really fascinating video today. Lofty AI getting the attention of MeetKevin, a YouTuber with about 2 million subscribers. He calls Lofty AI a scam. Now, I've had my own criticisms of Lofty AI, but scam is a little far. That's a pretty rough designation he added there. So, well, now he actually might get sued by it too. So we're gonna check that out. Before we do that, guys, if you wouldn't mind hitting that like and subscribe button, I really appreciate that. Remember, you don't have to smash it. You can just press it gently. It works just fine that way too. And want to give a big shout out to our sponsors, non-fungible domains. That's right. If you want that .algo address after your name, non-fungible domains is the way to go. Makes it a lot easier to remember than all those letters and numbers. And we're brought to you by Fractal Monsters, a play-to-earn game on the Algorand blockchain. You guys know I like this game because it actually works. You can go there and get a free monster right now. These guys are doing it right. So head on over to Fractal Monsters. Check out links for both of those in the description below. But let's get to this video. I actually did watch it beforehand. I've always stuck on whether I should watch them first and think of some notes, or if I should just react to them live. I've kind of done both. In this case, I actually watched it first, and I watched a little bit of his follow-up video because apparently one of the VCs that backed Lofty AI from the All In podcast is threatening to sue him now. So it was very interesting. Well, enough of my yabbering. Let's just watch this video, huh? Okay, so the video is called Danger Housing Scam Backed by Jason Calacanis from All In Podcast, Lofty AI. So I think you made the correct calculation that Jason Calacanis and All In Podcast is going to get more clicks than Lofty AI. It's going to put the actual scam, I put that in quotes, that he's talking about is Lofty AI, and it's like a footnote in the video. But I get it. I know how it works. I get it. And yeah, no, interesting. You know, I think MeetKevin has some pretty interesting videos. I don't always agree with him. It's pretty interesting, but well, let's just play it and watch what he has.
I think I have found the greatest real estate scam to exist. It is a company that is tokenizing real estate, and
why is he like putting scare quotes? It literally is tokenizing real estate. That's what it's doing. I mean, you might think that's a dumb idea, maybe. I don't know, but yeah, you can see, by the way, Jason Calacanis is already threatening to sue. This is the follow-up video. Actually the follow-up video got more views than the actual video, which I think is interesting, but let's let him continue.
Could be wrong with my analysis, but let me just say, this feels like a real, actual scam. Like, I've heard other people say things like, oh, that company wears company uniforms, or that company is founded by a YouTuber, so they must be a scam. But then people don't actually have any substance to back up that argument. Here, I'm going to show you what a real scam looks like. Take a look at this.
He's using pretty strong language here. I think there's some possible legal action. I was watching a little bit on the Discord of Lofty, and I don't think they're not very happy about this either. And they did mention some legal action.
First things first. Here's a company called Lofty AI, with AI in the name, so it must be good. And this company is VC backed, so it must be a good investment, right? Take a look at this. We based in Miami, Florida. Okay, that's interesting on the grammar side, but whatever. And have raised over $6 million in venture capital funding from investors like Y Combinator, Hustle Fund, and Jason C. from the All In podcast. So this must be a good investment. They're venture capital backed. Let's ignore the fact that VCs backed the WeWork guy twice, and he bankrupted WeWork twice. And let's ignore the fact that they just threw another $300 million at him for another real estate startup. Unfortunately, I think the track record says probably is not going to go in the right direction, but I don't know, maybe they'll do good this time, right? But let's just focus.
Okay, that's a really weird argument. I understand, like, listen, the VC model is to kind of throw spaghetti at the wall, so to speak. You're being a little bit selective with that spaghetti, but basically you're throwing spaghetti against the wall. You assume that, like, of 10 investments, maybe one will be a home run and a few will do okay, and a lot of them will do badly. So, like, yeah, I mean, I guess if you're making the point that like, yeah, venture capital funding doesn't necessarily mean that your project is going to be successful, I think that's a fair thing to say. But he's almost making it sound like it's a negative to have VC funding. It's really kind of bizarre. I mean, it's just maybe you just worded it kind of weird. But he's like, oh, well, maybe these guys will do a little bit better, but you know, those VC funded programs, like, I don't know, it's just I can't tell if it's just a weird wording or if he's like kind of making a really dumb argument, but I'm not sure what's going on there. But it's probably the worst argument he makes throughout this entire. Does he have something against Jason Calacanis, or is this just like to get clicks? I'm not really sure. I haven't watched a lot of his videos lately, so, and I don't really watch the All In podcast. I don't know anything about it at all, to be honest. So
Focus on Lofty. All right, so what is this? Fractional real estate marketplace. You can buy a token of these individual properties right here. So here you can see 14% projected yield, 16% projected yield. Looks cool. Let's take a look at this one right here. This one says it has an 18.8% projected yield. Okay, so let's go ahead and click on this. And this looks like a duplex in Daytona Beach. So we've got a nice sort of move-in ready duplex. Got it. Okay, cool. I can right now buy a token for $53. Okay, interesting. Now,
before he gets into this, just so you have the context before you watch this, this is when a price is not $50, that means it's on the secondary market. So when they offer brand new tokens, they're $50. And then at some point they switch over to be from the community pool that want to sell them. And then you see like these prices that go up and down. Okay, so and also you don't see new listing. Usually you see new listing, and I don't think we saw that. I was watching here. Yeah, pretty sure this is the one here. This one in the upper left, not quite the far corner, but the one next to it. This Wild Olive Avenue. Like, you notice it says 38 tokens at 54. Yeah, those are because it's 53.18. Yeah, that's not a price that Lofty sets anymore. They start out at 50. So all his calculations are already off because they should be based on $50, not 53, which when you're talking about thousands of tokens, that's a lot of money. But anyway.
and this looks like a duplex in Daytona Beach.
By the way, it's probably not like super fair to expect him to know this. Like a lot of this stuff, if you haven't like been knee deep in it, you won't necessarily know that. So I forgive him a little bit, but he's also like making really exact calculations and making arguments for that. So I think it's really important to point that out.
So we've got a nice sort of move-in ready duplex. Got it. Okay, cool. I can right now buy a token for $53. Okay, interesting. Now, there are two ways you could do this legally. One way would be as an accredited investor, but I don't believe you need to be accredited. There's nothing about accredited investors. The second way you could do this legally would be through a Regulation A offering or a non-accredited, and I don't see any references to that. In fact,
I actually think this is a third option. This is through a DAO, and each thing has its own LLC. So I think it's, I don't think, he's going to make this argument that this isn't legal and that the SEC is, I'm kind of preceding the argument, I understand, but he's going to make the argument that the SEC isn't going to allow this because they're putting out a security. But this is DAO ownership, which is a totally different structure than what he's talking about here. So I get why he's concerned, but I don't think it's if the SEC has a problem with DAO ownership, you know, so I get it. But I think if the SEC decides it has a problem with DAOs, then Lofty may have a problem. But I think he's looking at this totally wrong and not understanding. I don't think he did enough research on this to understand the structure, but it is what it is.
this is not a broker-dealer. It's not an investment advisor. And there's actually nothing about an SEC registration here for this tokenized real estate. So there's a really big chance, in my opinion, that the SEC is not going to be very happy about people soliciting slices of actual income-producing real estate without registering it as a security or an exempt offering. That's bad because it opens you up to really getting crushed by the SEC.
Also, like, I have a really hard time believing that this company is really public. And I don't mean public in the terms of like they have public stock, but just like, you know, they're not like operating behind the scenes or like trying to operate a scam operation or something. Like they're very upfront about what they're doing. They're being, I just have a hard time believing that they got together with their lawyers and their lawyers were all like, boy, that looks like you're going to get sued. And they're like, oh, YOLO, let's do it anyway. I mean, it's the idea that they wouldn't have done their homework is pretty insane, actually. It's kind of an insane argument.
But let's ignore the SEC for a moment. What value am I paying for this property and how much is this property worth? Well, you could scroll down and you could find the appraisal right here. And if I just click on appraisal, I'll open up the doc. There it is, 402 Wild Olive Ave. I scroll down and what do I get over here? I get, usually on the third page, value indicated by sales comparison approach, $625,000.
It's an appraisal done by sales comparison approach. And also, like we said, 53 is not, this is why this becomes really important. The $53 is not the price at the initial offering. So this calculation is totally off to begin with. But also, like, dude, you're in real estate. You know that one, the real estate market is really hot right now. It can sell way higher. It can sell for way more than the appraisal price. For an example, in my day job, I covered the city that I report in, buying land for like 3 times the appraised price. And that was enough to be like raise serious concerns. Like my house is getting revalued as we speak. That's an assessment, not an appraisal. They get, especially in a market that's this volatile, they get out of date really fast. So for him to say like, oh, the appraisal said it's worth this, so that's exactly what they must have paid. Like, not really, but sure.
Or the income approach, $687,000. Okay, so you have to be careful with the income approach on anything under 5 units because you generally have home buyer purchasers, and usually home buyer purchasers are people who are...
Did you catch that? Hold on. Look at the very, very top. Look at the range. The range is from 525 to 950. That is a huge range in that neighborhood. So him like saying, well, the appraisal says this, and acting like that is the exact value. I know he knows that that's not true. You know that he knows that he's BSing you because he knows real estate. You know how much these prices can fluctuate, and you know that when you go to market, you can sell these things for way right now, especially. You know I know a lot of real estate agents, and they are selling their houses are like going for like 20, 30 over. And that's in my place. I live in a pretty low cost of living area. Like there, when I bought my house, I put in a low bid. I got like 10 or 12 off. What was it? Yeah, it was about 11,000 off. And my house was under 100,000. Now you can't touch one for even close to. They're actually getting up to 2. I'm kind of curious what my house is going to be revalued at, because the city assessor is going to be revaluing it. So again, when you use these numbers, you have to be really careful how you use them. And Kevin's being uncareful. I think he just kind of wanted to make a point. There's some points that I'm going to sort of agree with him later on, but we'll get to that.
Really have home buyer purchasers, and usually home buyer purchasers are people who are sort of house hacking, owning one or living in one of the units and renting the others. Those usually are going to sell based on the sales comparison approach rather than a multiplier. Once you go over 5 units, that's when you're going to get that. Now, what we could do is we could take a look at the rent that the appraiser is using and compare that to the actual rents they're getting. So let's compare that. We've got a gross rent multiplier here on their subject property. They're assuming $5,500 of rent. $5,500 of rent, and we can compare that to what they say they're actually getting, which is, oh, how interesting. It's less than that. So it's 2625 plus 2,600, 5225. So
it's like a little bit off. Again, that's so nitpicky. Like again, this is an appraisal. This isn't like the exact figures. So like they're close, but not. It's possible when they took over, they thought, we'll lower the rent a little bit to get some people in. But that I mean, it's off by like what, 375, 275, 275, less than 300. So I don't know.
Already on the sales comparison approach, the appraisal doesn't line up with the rents that we're actually getting. So 5,500, we're already off 5% on the rents. So the income approach is probably off by 5%, which...
That's a lot less than 5%. Hold on.
Is just about $30,000. And that kind of weights you down to about that 625 value on the sales comparison approach anyway. So let's say it's worth plus or minus, $650,000. Let's just assume that for a moment. Okay, so we assume it's worth $650,000. This is being sold at $53 per token.
Again, as we explained, now it's being sold at 63. It was 53. It would have landed as 50 because they all start at 50.
So there's probably a market cap, a way to figure out how many tokens there are in total. View order book. Aha! Okay. 12,867 tokens. Now I could take their word for it and say it's $643,000, but I can't buy it for $643,000 right now. I can only buy it for the starting price. This is the lowest current price per token available, 53.18. 53.18 times the tokens outstanding. How interesting.
Yeah, so the calculation was based on, I just did the math. I didn't do it before when I watched it. The figure they had is actually correct for the $50, which is what now you're paying 53. So you like yeah, maybe your calculations changed a little bit, but when it was initially offered, it was offered at 50.
I'm actually paying more than the appraised value on both ends for this property.
No, you're paying the same. 650 is what the 650 is the figure you used, and 643, so actually just a little under, is what it actually comes to if you use the correct figure, which is $50.
I'm paying $684,000 for this property. But
not that you shouldn't take that, you know, now it's 53, so you can redo the calculations at $53 because that's what you're actually paying. But I'm saying like their figures are figured when they first offer it.
Wait a second. Is this property owned free and clear? Because if I'm going to pay $684,000 for the property, I would assume that I'm getting $684,000 in equity, right? So again, let's say the value, and I'm being generous here since you should be using the sales comparison approach, the 625. Let's say we go with 650. You pay $684,000 for the property. So right away, we're already overpaying by $34,000. Okay.
By the way, 643 is the actual number, but
fine. Let's assume we're okay with that. Am I getting $684,000 worth of property, or is there debt? Well, let's find out. If I scroll down right here, I can see, here it is. This property has a loan of $429,000. Okay, so I'm not getting a free and clear property. Now, there's this weird arrangement where it says here that the seller is actually going to pay the loan payments themselves, and in exchange for that, their equity is going to go up and they're going to dilute you. So basically, they make a payment, but every time they pay, they just make you pay for it. So basically, they're not paying for it, you're paying for it. So you're paying for the debt in the form of dilution, which is a very weird arrangement. I haven't seen that before. But let's just ignore the fact that they're paying for the debt with your share value for a moment. You're not actually getting a free and clear property here. You're paying $684,000 for a place that's worth $650 minus the loan of $429. I'll round down to be generous. $650 minus $429. Oh.
Not being generous, actually being accurate.
So I'm getting $221,000 of equity.
By the way, this part I actually do find a bit concerning. I don't know enough about it to evaluate how concerning that is, but it is something you should definitely be aware of. I'm going to share some. Just to be clear, I'm not here to like totally defend Lofty because I have my concerns as well. And in fact, I am not really actively buying on Lofty anymore. I'm actually trying to sell some of my properties. We'll get into that. So it's something to be aware of, I think.
So I'm paying $684,000 for $221,000 of equity. Wait a minute. 221 divided by 684. So if I put $100 in, I've already lost about $67 to dilution. But wait a minute, there's more. How could there be more, Kevin? This is venture capital backed. Venture capitalists understand real estate. But wait a minute, it says here that this company manages the property and will maintain 10% equity in the property. So they have a 10% ownership in the property. Is that 10% ownership a token? Because if it's not a token, then what you're actually buying with $684,000 is only 90% of the property.
I mean, that's potentially a good point. I'd be curious to know how all of that fits in. So this one is kind of interesting. I don't think a lot. I looked through a couple other ones and they didn't seem to have that. So I don't know if it's unique to this particular property. I haven't seen that 10% fee in. I looked in a couple of them. I didn't look at like a bunch of them. So, but I don't remember having seen that in ones that I've looked at before.
Which means you're paying $684,000 divided by 0.9. You're actually paying $760,000 for the property. So if they own 10% and this token only represents 90% of what you're buying, you're actually paying $760,000. It's possible that that owner owns their 10% as a token, in which case, sure, you're paying the $684. But that is something I'd certainly want some clarity on. Now, they also have a property management agreement where it appears the management fee is 10% to that person who owns part of that, what's it called? 10% ownership in the property. Landlord may terminate this via a governance vote, and so they have their voting opportunities here. This is how they set up quorum and otherwise, so you could fire the manager through the token ownership. Fine. But in order to get a token to actually have that right to be able to do that, you need to pay $684,000 for $221,000 of equity. Now, could it possibly get any worse?
Okay, maybe
because let's say I said, you know what, I want this.
Maybe I'm dumb, but as the loan gets paid off, would your equity not increase, or am I missing something? Because they're not keeping equity. Because I don't think it's obviously not the it's obviously not the your tokens aren't the 220, because we just calculated that. So what he's saying is only accurate if it's if those tokens only divide up this 221, in which case he would be that's really alarming, but I don't think that's the case. I assume that the loan gets paid off, your equity increases, but we actually have an official response from Lofty, so we're gonna look at that in a second.
I want to, you know what? I'm gonna buy every token that I can for this. I'm gonna pay $684,000. I'm gonna put my money into this because I think this is the best thing ever. I get tokenized real estate. Don't mind the fact that the SEC is probably gonna shut this down. In my opinion, I could be wrong.
I think he's wrong.
So let's say I wanted to pay $685,000, $84,000. What other fees are there for this? Oh no. Lofty's efficient design and use of a smart contract ensures fees are very low. There is a 2.5% platform fee for buy orders of traded properties and a 2.5% sell order fee. Okay, got it. So if I want to own 100% of these tokens, I'm now going to pay a full real estate commission, or $17,100. So minus $17,100 when I buy it, and minus $17,100 when I sell it. Got it. Okay, so I'm gonna overpay for $221,000 of equity by basically, $420-something thousand or $450,000. The difference between these two numbers here, right? What is that? 684 minus 221. So I'm gonna overpay by $463,000. Then, so 463. Then I'm gonna pay $17,100. Then I'm gonna pay $1,100,000 to get out. So now I'm actually overpaying for this deal.
I think this is actually a pretty good point. That's a lot to pay in fees, I think. 2.5% is a little high. And there's others. So there's an automatic market maker, and you can stake US dollar coin to help put liquidity into the automatic market makers. What they don't tell you when you put it in is that there's an enormous something like you get like $30 back if you put it in and you take it out early. And they don't really define that because they don't really tell you when you sign up for it. You get soaked. And like it was really poorly explained to begin with exactly how it worked. Like I read through all the official documentation. It's one area where I think crypto in general needs to work better on, and Lofty absolutely in this spot needs to work better on this, because it's like it just there's a tab, you go to it, and there's some options, but nothing really explains anything about how it works. And even the documentation is really poorly explained. I think they should bring someone in. Any of these crypto companies, really, they should bring somebody in who like doesn't know crypto at all, and just be like, does this make sense to you? Okay, what doesn't make sense? And start user testing this stuff. I would like to see that more.
By a delicious $497,200, assuming that's 100%, and that manager isn't only selling 90%, right? So I'm overpaying by 500 grand for a property that's a duplex in Florida that they're promising an 18% yield on. But wait a minute, what rents are they getting? 2,600, 2,625. That's less than what they said in the appraisal. Let's do some quick math on this. Let's see what we can get. 2,600, 20.
By the way, the Lofty platform will tell you how much you're earning, and you should pay attention to it. Actually, the worst thing is when you have to pay. We're going to look at its calculations, but you can see it exactly. The worst is when you actually have to repair stuff, and then you have to meet the reserve, and a lot of times it'll be like half rent or full rent will go to the reserve, and so you're not getting anything for a while. I had a period of time when I was like half of my properties were paying zero rent. Either they were vacant or they were just starting to get people again, but there was so much damage to pay for. Or sometimes they will offer people a certain amount of money to just leave, send in the keys. And, it is easier than going through the eviction process. But what I think Lofty is great, it's a great example of like, hey, these are the things that happen in real estate. If you own a property, this is the stuff that can happen. So I think it's interesting.
2625, okay? So we'll do this together. 5225 times 12. All right, $62,700 in gross yield, but we got to pay property taxes, insurance, maintenance, management, utilities, reserves, and it's a 10% management fee. So with a 10% management fee, I'm probably using an expense ratio of 40%. So I'm going to have NOI, net operating income, of $37,620. $37,620 divided by what I'm paying for this, $684,000. I'm actually getting a 5.5% yield, assuming I'm willing to overpay by 500 grand and pay their 2.5% in and out fee. Interesting. So now, if I divide it by 760, assuming they only sold 90% of the property, I'm getting a 4.9. Now, it might seem like, hey, 5.5% or 4.9, that's actually pretty good, right? But wait a minute, that's the yield of the property, not actually the yield in your investment. Because your investment that goes in at $684,000 is only worth $221,000 because of the debt. So
the bigger thing here actually, I think, is like, you're actually buying a $50 token, but the real question is, what does that token sell for later on? I will tell you, when I've sold some of my tokens to the automatic market maker, you get way less than Lofty tells you they're worth. That's a real issue, I would say. I think that's pretty much the bulk of his argument. The rest of the video is talking about now. I'll sum up this one because this video is already getting kind of long. Basically, Jason Calacanis called him from the All In podcast. He was one of the investors mentioned earlier on, called Kevin and said, hey, you son of a gun, I don't like what you did. I'm going to sue you. Kevin said, hey, can we talk it out? Can you call into the show? We can call in. We can have a discussion about it. He said no. Obviously, the video is still up, so he's not backing down. One interesting thing here, Kevin, you're talking about, it's kind of funny that you're calling out scams when, where were you when FTX was going down? Because you were recommending FTX, by the way. You were recommending FTX, but, that apparently is okay. Let's forget that you recommended FTX to everybody. But here you are calling out this platform, which I don't think is a scam. I think it's maybe not. I've gone away from recommending it, but I don't think it's a scam. But let's just see what Lofty's official response is. Our official response to MeetKevin. Hi everyone, my name is Jerry Chu, and I'm the CEO of Lofty. I'd like to take this time to introduce myself and address a video that came to our attention recently. We want to be detailed in our response and break everything down one by one. So this will be a long read. By the way, I've made critical videos of Lofty and they've never come out and attacked me. So this one really hit them. We're 100% not a scam. I think that's fair. So as you can see, some of their comments trying to correct Kevin in the comments section. So what is Lofty? Okay, addressing the How is Lofty related to the All In podcast? Chamath, they included a picture of Chamath. Chamath has nothing to do with them. Only Jason Kalkanis, an investor. What? Actually, that's the impression I was left under. So our name, AI, well, they actually use AI. So it does use AI to predict which neighborhoods will have higher than average price appreciation. I don't know if it's done great, but that's and I don't know it does well to identify where people will pay rent, because a lot of the properties I've had have had issues. But yeah, okay. I was going to point that out, but I kind of want to get to other things. We also have a legal opinion confirming this from one of our top law firms in the U.S. with strong securities law practice. See, I told you, it's like, okay, under current regulations, LLC interests are not securities by default, which is what I said. I said, they would have this. It's a nuanced analysis, and the Howey test is often used by regulators and lawyers in this context. Management rights are important, and in general ownership in an LLC, even a multi-member one, which is what these end up being, where all owners are legally and practically have management control, is not considered a security. Exactly. So you can actually vote. The votes come through all the time in my inbox. I ignore a lot of them. I don't always vote, but it's there. Are owners overpaying? Okay, now we get to the crux of the issue, which is that Kevin thinks users on Lofty are grossly overpaying for their properties. This is not true, and Kevin was not using correct numbers in his calculation. Again, he reached out to us. Had he reached out to us to ask how the platform worked, you would have explained it to him, so there are misunderstandings. I'm not going to go through this one. It's important to note that different properties of Lofty and structures, blah, 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 blah. As you can see, financials page is probably listed for sale at a total value of $640,354. That is assuming that if you bought 100% of the property with no loans on it, it would be that much. And that is, we did the math. That's exactly what we came up to. 50 times the number of tokens, which was, I can't remember exactly now, it was like 12,000 something. You come up with that number. So whether you think this listing price is fair or not is up to you. And I think it's fair. Again, it's an appraisal. So you have one that it's kind of splits in the middle between the appraisal before the sale based on comps and one based on income. So I'd love to you're free to make bids at any price you want. You're not forced to make bids at $50 a token. I'm surprised they didn't make the point, because the $50 a token, oh, here it is. Yeah, I confirmed that in total, 12,867 times 50. We just did the math too. It's 643.35. And that's what they launch at. So that whole thing, he was just using bad numbers. And he didn't know how it worked. I get it. But yeah, I thought this was weird too, because if you bought a property, there might be a loan on it, but that loan's going to get paid. That loan's going to get paid back. Like, that happens all the time. You buy a house that someone doesn't own outright. Like, I don't know. That didn't seem that weird to me. I think that was a kind of a strange argument, but everyone is getting diluted. This is the part I want to ask about. Okay, there's also confusion around the concept of dilution. This is where confusion might come from. The token portion that represents the debt is held in a wallet that the seller and other co-owners don't have access to. Whoever pays the monthly mortgage payment will unlock a portion of tokens each month for themselves. Before a seller can list on Lofty, they must obtain approval from their lender. Not all lenders will agree, so many sellers who reach out actually end up not being able to sell through Lofty, but some of the sellers have enough of a history with their lenders where the lenders did agree. Cal, the seller, is the one currently paying the mortgage payment, so he's buying a portion of the equity back from the lender with each successful payment, which is fair. This is also the default arrangement, which can be changed through the governance program. All token owners are active managers, and if the DAO is a group vote, that is maybe, well, Oh, I see. So he's getting the portion of the tokens. No, that's okay. If it was outside of the tokens, it would be bad. I had to think about that for a second. If it were outside of the tokens, it would be disastrous, because it would mean it'd be diluting your value. But if he's just getting more token, he's just getting some of the tokens for the equity that he's buying, that makes sense. So you're buying the parts that are unlocked. So what if you buy, one question I would have, what if you bought a property, what if you bought a token beyond whatever that 243,000 number is? I don't think he did, but like, because they have that total number available. Would he be paying you for the tokens? Is that how it would work? That's a little curious, but okay. Why are yields so high for some properties? Reason yields are high is because of the debt leverage in place. You're essentially receiving leverage at terms, which is why your yield, cash on yield, is high. That's especially true if you're not paying for the debts each month. Yeah, they're trying to, I think, lower than what real estate agents currently charge. Yeah, but they're going out and selling. I think I think Kevin had a point here. I think 2.5 is a little high. You know, you can do it outside the platform, but it's really hard. I mean, okay, so that's their whole response. The fees is the one I don't agree with. Interesting video. My bigger concerns about Lofty is what happens is a lot of these properties just end up not paying. You have to be really careful what properties you select, and it's really, really hard. It's actually really, really hard to sell properties on there from what I've found. If it has an AMM, then you can sell it pretty easily. Oh, but you have to own it on their wallet. You can't own it on your own wallet right now and use the AMM. The automatic market maker will allow you to sell it without needing like another buyer present. That's why the pool is there, but you'll get like pennies on the dollar. It's really bad. And it's way less than Lofty says it's worth. So Lofty, your token will say, oh, it's worth $55. When you go through the AMN, it will be like 30. It's crazy. So that's one thing to keep in mind. Yeah, I've pretty much stopped buying. I'm not buying any more properties on the app, and I'm actually trying to sell some off and just put some of that towards DeFi. I think it's just for the kind of yields you're getting. Honestly, you can just do DeFi. It's a lot easier. It's a lot easier. You'll get the same, probably more, actually much higher percentage, just like going through like Tinyman or something. So I have my criticism of Lofty. I don't think it's generally a good idea. I think it's cool. It's a cool concept, and I don't think the SEC is going to be knocking on their door unless they're just going to start doing that for DAO ownership in general. But I will say that, you know, I don't think it's the best idea unless you just really want to play around with real estate. And you'll find out the realities of real estate, because like people don't pay their rent and then they get stuck there. You have to pay them to leave. A lot of times they do damage. That comes out of your rent. So yeah, like I said, at one point, like half my properties weren't paying rent. I had like 20 some, and half of them weren't paying rent, more than half. So it's getting a little better lately. It's been better than it was during that period, but interesting video. I wonder, we'll keep an eye out, see if that lawsuit ever comes back. I didn't realize the kind of backing Lofty had, because it's pretty cool to see that on Algorand. But yeah, that's it for this week. I hope you guys enjoyed this video. It's kind of a long one because I wanted to do this reaction, but there's a lot to go through, and I definitely wanted to go through Lofty's response to that. But starting a Discord server too, so that'll be available soon. I'm kind of inviting some people I know just to kind of test it out and stuff. Kind of going away from Twitter a little bit, so keep an eye out for that. Otherwise, I'm FrugalBC. Stay safe out there, and I will see you in the future.